Hello, this is Shannon King with SilverOak Wealth Management. Welcome to today's quarterly webinar. As with prior webinars, I want to introduce Jonathan Charlo. Jonathan, I'm assuming you are with us?
I am.
Well, thank you for joining, and I'm glad our technology mix-up a little earlier got all figured out here. As everybody probably knows, we're still under our business continuity plan, which means most of us are working remotely. There's a few of us in the office, but this is only our second time going through a webinar entirely remotely with Jonathan and I not in the same room. So Jonathan, I miss being next to you and going through this, but we'll get through it today.
Absolutely.
So as with past webinars, we're scheduled to go approximately 45 minutes or so. I think this one may go a little bit longer than 45, potentially up to 60 minutes, but we do try and limit it to no more than 60 minutes. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not currently working with an advisor, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan and John and the rest of the SilverOak team for making the webinar possible, including everybody on the technology side and getting some of the bugs worked out so that we could run smoothly here this morning. And since I am the Chief Compliance Officer, I guess I get the honor of making a couple of compliance notes. First, we will be discussing the overall markets and economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We will also not be discussing specific SilverOak portfolio performance, as each of our client portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports within the last week or two. If you have specific questions, feel free to reach out to your advisor if they haven't already contacted you. And lastly, past performance is no guarantee of future success. So with that, let's take a look at today's agenda. As is typically the case, we're going to start with a discussion around the economy. We'll transition into a discussion on the markets. We'll give our outlook as we're looking forward to the next month or quarter or even the rest of this year. We also want to touch on kind of the historical perspective of the recent market and economic activities that have occurred over the last couple of months. It is interesting that if you looked at the beginning of the year at the markets as of January 1st and you looked today, you frankly might think, Jonathan, nothing happened. Where in reality, we're going to see that obviously tectonic plates have shifted in the course of those few months. Then we're going to talk about some important updates. I think we actually even give a couple of reminders. And then, of course, solicit questions for our next webinar. So let's start, Jonathan, with the economy. And you say here that there are signs of early improvement during the second quarter.
Yes, absolutely. So while the economy isn't, obviously back to full capacity because of social distancing measures, we've definitely seen impact in consumer-oriented industries, but industrial and other areas of the economy are starting to come back, and we'll show that in future slides.
Perfect. Well, and I think the best place to start when we have a discussion about the economy is to look at our market dashboard. And I want to preface the data that we're going to be looking at here, and particularly on the next slide as we start projecting out the next quarter or couple of quarters, is that so much is dependent upon COVID and the health situation that we're in. So, take these projections as we get to them with a very, I guess, skeptical perspective, because these can change dramatically over very, very short periods of time. But as we look back, and this is what this chart's doing, it's looking back over the last several quarters, going back the last couple of years. As everybody hopefully knows by now, we break the dashboard into 4 segments. We start with the first major segment, the economy overall. And it's no surprise that we went from being positive through 2017, 18, and into 19 to more of a neutral position throughout 2019. And then, of course, COVID hit in March, and that turned the economic data red. So green is good, gray is neutral, red is bad. The next segment of the dashboard is the credit markets. And we're seeing here, Jonathan, that those have also turned negative. Anything that you want to touch on specifically at this point?
No, other than the fact that with the Federal Reserve stepping in, things have gotten a little bit better, but not enough to cause the red or negative to go to neutral at this point.
Sure. Okay. The third component of the dashboard are valuations. And we had been in red through 2017 into 18. Then it turned more neutral, and we are back to red. And the one thing I want to point out here is valuations. When it's red, it means valuations are high. So that's good on one hand, right? We all like to have strong equity markets, but when it's red, it means that the valuations are probably ahead of the fundamentals. And we're going to definitely get into more discussion around that, and frankly, more discussion around the credit markets and the economy as well. And then the fourth component of our dashboard is market sentiment. And we obviously saw a big shift to the negative in overall sentiment, which drove really the composite dashboard down into the red for the first quarter, and that's where it's remained here during the second quarter. As we look forward, and again, this is where I would be a little bit skeptical of some of these projected numbers because they can change dramatically. But as we look forward, we do expect the economy to pick up. And maybe at a very high level, Jonathan, can you just touch on a couple of the points that would drive us to a conclusion that we hopefully will see this pickup in the economy?
Sure, and we'll show some of this in slides, but leading indicators are improving. So the LEI and things like that. We've seen actually very strong housing numbers, and in fact, this last week, existing home sales came out, and it was actually the biggest monthly increase that we've seen. And that we'll also go through this, but the employment picture, while still pretty bleak, has actually gotten a little bit better in the last couple of months. And we do expect to see at some point later in the year and into next year a rebound in corporate earnings.
Sure. So all those really are contributing to this maybe more optimistic perspective going into next year. And again, all of it's predicated on COVID. If we continue to have these resurgence in cases, and states are going to have to put more restrictions, hence the economy is not going to get back up and running as quickly as maybe anticipated right now. All of these more optimistic projections could be shifted out into mid or even late next year. So just make note of that, please. As far as credit markets, as we look forward, it looks like we expect those to pick up, and I think, Jonathan, some of that is around the Federal Reserve stimulus that you made reference to. But hopefully that will improve throughout the rest of this year into next year, so much so that we can get back into some positive territory there. And valuations. Now we don't see valuations really improving much in the foreseeable future. We'll touch on valuations. Is there anything specific here that you want to touch on though, Jonathan?
Yeah, a couple points. Really, what's going on with valuations is that the market has recovered because it's looking forward. It is looking forward 12, 18 months to an earnings rebound. Um, and so think of it as basically what we thought was this year gets pushed out to next year or maybe into the beginning of the following year. And then the second point would be that valuations are not timing tools for the market. And so valuations can be high for long periods of time. It doesn't necessarily mean bad things for the market in the short term.
Well, and I think that's a really good point. And I know we've discussed that before, at least amongst ourselves. I'm not sure how much we've pointed it out in our webinars, but valuations can stay extended for very, very like years, very long periods of time without major pullbacks. And then we get to market sentiment, and our projections there are actually that this quarter we're going to see an uptick in sentiment. Is there anything specifically driving that uptick so sharply in sentiment, Jonathan?
Well, there are a lot of different consumer confidence indicators that go in there, as well as market indicators. And this is actually the most sensitive of the indicators, so it actually changes the most quickly. And so that's really why the projection is that it improves that quickly.
I see. Okay. Well, that brings us then to the composite. And unfortunately, it really doesn't look like there's going to be much improvement in the overall composite over the next couple of quarters. But there is light at the end of the tunnel, as we can see, shifting to a more neutral toward mid next year. But again, some of these components shifting more neutral to positive even prior to that. So if we look at the dashboard, going back, we can see obviously the movement of the dashboard relative to the overall stock market, the S&P 500. So the blue line on this chart is the S&P 500, and then the green, I believe it's green and orangish bars are the dashboards, either the current numbers or the 6-month trailing average numbers. And obviously at the far right of this, you're seeing a very sharp drop off. That is the COVID-related drop-off. But again, we hope to see some improvement in that number going forward. As we transition from the dashboard to the economic factors, let's look at these various components of the economic factors, which, as in prior webinars, we categorize from positive, neutral, into the negative. As I put these various components up, you'll see that all of these, the fiscal policy, monetary policy, interest rates, and US inflation, are positive. And they've remained positive. So, Jonathan, if we think back to last quarter, for those that weren't on the webinar, all of these would have been in that positive category, and really there's been no shifts there, correct?
Correct. The only update would be on fiscal policy, that it looks like they are working hard to finalize another round of stimulus.
Good point. Under neutral, commodities. Now that has a negative connotation there next to it, or denotation next to it. Why does that have a negative denotation next to it?
Well, last quarter commodity prices had come in, especially when you look at oil. Whereas this quarter we've seen a partial recovery in the price of oil, and we'll show a chart there. But we have actually seen an increase in oil, silver, and generally in metals markets on the basic materials side. And so to the extent that those prices continue to go up as input costs, it will raise costs for manufacturers.
Okay. Oh boy, there's a big one. U.S. politics. We're going to talk a little bit more about U.S. politics later, and I should have mentioned this when we went through the agenda, but we are going to have some statistics with regards to how the markets do relative to different parties controlling either the White House and or Congress. So we'll get to U.S. politics here in a few minutes. The U.S. dollar has remained in the neutral category. And then housing, and housing has an up arrow next to it. Is that just signifying the improvement that we have seen in the housing market?
Sure, and in fact, it does seem that there was some pent-up demand that we've seen most recently. So we'll obviously have to watch and see, whether that trend continues or whether that was really kind of more of a short-term bounce.
Well, and the other thing that we probably should mention when we talk about housing is that at least earlier this week, I believe it was, mortgage rates hit all-time lows, which has sparked a lot of refinancing, which we're going to get to, I think, on the next slide. But if anybody has a mortgage that they haven't looked at the interest rate on for a while, you might want to take a look at that, because I've had clients that refinanced maybe last year or 18 months ago that are seriously thinking about refinancing again. They thought their rate was low last year when they locked in the new refinanced rate, but now they're even better. And in some cases, it does make sense, even though it's been a very short period of time since the last refi. Sometimes it will make sense to refi again. On the negative side, we have corporate earnings, and again, negative, the notation there next to it. What is the reasoning for that, Jonathan?
Well, we're going to show this on a slide, but obviously with the economic shutdown, it's impacted certain areas of the economy and many companies. And so as it stands now, corporate earnings estimates for this year and next year are unfortunately being downwardly revised, not surprising. But the other side of that is, as we mentioned, the market is looking forward 12 to 18 months when corporate earnings should start to recover.
Sure. Then we have employment, which you've already touched on, and I think we'll touch on a little bit in a few minutes. Consumer confidence, which gets somewhat into the sentiment discussion we had a few minutes ago. Credit conditions. Global growth, although you have an up arrow on global growth, so it's negative, but the up arrow is indicating maybe a little bit of optimism in the
A
future.
little bit in the sense that we're definitely seeing Asia, certainly on the industrial side, start to restart. We've seen some better numbers out of China, and maybe we've actually hit our low point.
Okay, which kind of gets to the Eurozone, and then we see China with the up arrow. Now, with what's happened over the last couple of days, I suspect we could say, well, maybe things aren't quite as good if we're thinking of China, tariffs, and geopolitics. Maybe they deservedly are in that negative category, because it looks like, at least on the geopolitical side, there's some more rumblings between the US and China. So with that, let's get to some more optimistic information. And here we're saying that activity has started to recover. I mean, obviously in very particular sectors, but you're showing here that mortgage applications, as we just referenced, are on the uptick, and driving direction usage, I guess this is probably out of some type of Google big
Correct.
data.
Yes, yes.
Okay. Anything else here you want to touch on?
Well, kind of in the middle range, you'll see hotel occupancy and global airline flights. Those have bounced off the bottom. Now still down 30 to 40% from where they were at the beginning of February. And then probably not surprising, but US travel data, TSA data, as well as US seated dinners based on reservations on OpenTable are still down a ton. They've come up a little bit, but they're not down 100% anymore, but they range from kind of being down 70 to 90%.
Well, and you also put together some information that came out of the Census Bureau that we're seeing some upticks anyway uh, in, let's say, June from May with regards to retail and food sales, things of that nature. Is that correct?
Yeah, so the data, for June was that basically sales were up 7.5%. And then when we look at that relative to June of last year, 2019, they're actually up 1.1%.
Hmm. So that's encouraging. But we are starting to see signs of the economy getting back into some sense of a restart.
Yeah, absolutely. And those numbers, by the way, are much better than even what they were in April and May. So.
Good, good. Well, and talking about the restart, a big component of the restart is manufacturing, and here you're showing a really big uptick in the PMI.
Yeah, absolutely. It hit its low point in April at 42, and in June it shot up to almost 53, which coincided really with industrial companies being essential services companies, they're being able to come online. And again, the only thing I would caution though is this is survey data, and basically the Institute for Supply Management, as well as many of the other data sources will show today, have cautioned that the data is very short-term in nature, and they don't have as many respondents as they had pre-COVID.
Hmm. Yeah, that's a really good point. All right. Well, then let's look at GDP because for those of you that aren't aware, next Thursday, I believe, is the 30th. And on the 30th, second quarter GDP gets announced. And just be prepared. You're probably going to hear about it on the news cycle uh, on Thursday and Friday into the weekend, probably, because it's not going to be good. But we always have to remember pretty much any economic data point you give me, it's looking backward. And of course, we're getting the GDP next week for last quarter. So it's not a forward looking number, it's a backward looking number. And we know it was ugly. We know second quarter was bad. We hope the bottom. But what are we seeing here, Jonathan, with regards to what we expect
Mm-hmm.
next week to hear about GDP?
Well, this data is from the Atlanta Fed, and they have a report that they really publish every couple of weeks called GDP Now. And so this is really tracking their, think of it as an ongoing estimate. It is not set in stone, and honestly isn't necessarily always close to what is released. This is their kind of internal tracking, and they've decided to publish it. And so what you'll see is that if you remember back to the last webinar, the viewpoint was that we could see on the low end the economy down about 15%. And what you're seeing is that as we progress through the end of May, the estimate got as low as almost down 55%. And then as more data came in, it kind of came up to now it's down about 35%. And then we had showed a chart last quarter where we had a consensus of a number of banks and their viewpoint on where GDP could fall. And it looks like they're both kind of now in that 35% range. But again, I caution you, it could be several points different from that, either way.
Sure. Sure. Okay. Bad nonetheless, but again, don't get too caught up in looking at economic data, especially as you're thinking about forward-looking markets, because the economic data is backward-looking, markets are forward-looking. Now, as we transition here into unemployment, obviously we saw a huge spike in unemployment. That coincides with a big drop in GDP. But you had mentioned earlier that the employment situation is looking at least a little bit better. And that's what we're seeing here.
Yeah, so definitely there's a dot showing May's unemployment rate, and you can see that's a little bit less than the high point, which was in April. And then I updated that by showing you where it was in June at 11.1%. And then the other sort of data point would be wage growth, and that also kind of is off that high. And so for May, we're looking at that a little bit lower than it was in prior months.
Okay. You mentioned also that oil had come off its lows, and that's what we're seeing here, is that you're getting that little bump up off of what was really historic. I think the futures contracts actually on oil maybe even went negative.
Yeah, they did. In fact, at their low point, they were down more than $30 a barrel. And that was because there were some financial investors who essentially bought the contracts and honestly didn't realize that if they held the contract to expiration, they'd have to get physical delivery. And so this happened the day before those options expired. And so they basically had to offload them because they didn't have the ability to have storage. And so many industry participants who had storage available to them were able to buy at very, very negative prices. And with this rebound have made a good return on that. But really what's happening is we've seen economic activity pick up off of the bottom. So supply, we know was, there was a glut kind of ahead. And then we have actually seen supply in the US come down. Production is down about 2 million barrels a day. And the Saudis and the Russians have actually brought their production levels down. So things have tightened up a little bit.
Okay. Well, and you know, we've talked so far about some of the economic activity beginning to at least show signs of improvement off of the bottoms. We talked about manufacturing. We know GDP is going to be tough. Unemployment's certainly, you know, not good, but at least better than it had been. Starting to see the rebound in the commodity prices, but really maybe what makes the biggest difference is earnings. And I'm not sure what's happening here with these slide builds, so my apologies, but hopefully everybody can see both sides of this slide build where we're showing earnings. This year, it's pretty easy to see this year amongst all those different colored lines because it's obviously registering a huge drop that we expect this year earnings to be down about 21–22%. But then next year, what you're seeing kind of on the left side of this is next year we're seeing a projected bump up of around 25%. Is that how we should interpret this?
Yeah, yeah. The only thing I will say is that, you know, we're still in the midst of earnings this quarter. And so it is possible that this year's number will be even lower than 22%. But again, as we mentioned, this quarter is probably the low point for earnings. And so that's something to think about. But I think with all the fiscal and Fed support, we'll see, you know, maybe earnings go down a little bit more, but certainly not as bad as they were back during the financial crisis, where earnings actually went down by about 50%.
This next slide, we're showing the earnings declines, but by sector. So it's pretty clear, and I think obvious to most people, certain sectors have been hit harder than others. And you know, as we look at this, energy obviously down 100%, consumer discretionary 57, while some of the others, healthcare, real estate, maybe not quite as hard impacted. What I found most interesting, though, was this information, Jonathan. Do you want to walk us through this? Because I think this kind of leads to people being maybe overly optimistic, and maybe we should soften some of that.
Yeah, absolutely. So on the far right with the circle, what I'm showing is that we know that earnings are going to be down in 2020. And then as we mentioned, we'll have a nice bounce in 2021 and then growth again in 2022. But what this is showing is that currently consensus estimates are that by the end of 2021, earnings will be higher than they were at the end of 2019. So basically an earnings recovery in 1 year. And then if you look back in prior years, you'll see back in kind of that 15 period, there was a couple year period where earnings were down. But in that case, you know, they were down for 2 years, and then it took the third year to exceed the prior high. And then we look back to the financial crisis, and there we had earnings were down for 4 years, and then, you know, and so forth. So I hope that the analysts are correct, but it might be a little bit optimistic. And instead of exceeding it in 21, it might be in 22.
Okay. All right. Great information. So as we finish our discussion on the economy, now we want to start our discussion with regards to the markets. And obviously there's been a dramatic rebound in risk assets. As I mentioned at the very beginning of today's webinar, if you didn't know otherwise and you just looked at January 1st and looked at, you know, July 23rd or 22nd, you would have thought not much happened. But we all know that not to be the case. So as we look at market performance, we can see second quarter super strong, double-digit positive returns pretty much across all of these different types of equities, whether it's U.S. large cap, small cap, international, so on and so forth. But again, year to date, the story is a little bit different, because on a year-to-date basis, pretty much everything is still negative. Now, this was year-to-date as of the quarter end. Markets have improved even since the quarter end, so generally they've been up here in July, and the S&P 500 is closer really to kind of that break-even point. But this doesn't even tell the whole story, because if I look at information as of June 30th, so the end of the second quarter, and I kind of look at, let's say, large cap stocks, so big US companies. The Russell 1000 value, which measures big US companies that are more value oriented, that segment of the market's down actually 16%. Whereas the Russell 1000 growth, or US large cap companies that are more growth oriented, it's up 10%. So there's this big diversion between value and growth. And actually, if we looked at the NASDAQ, which is even more heavily weighted toward technology, it's up 17% almost. So there is a wide dispersion of returns, even within some of these categories that we're showing here, like the US large cap. And then, of course, as we look at bonds, bonds have been up in that low to mid single digit range, along with commodities and REITs. On a year-to-date basis, we're seeing bonds positive. They're doing what they're supposed to do, and that's provide that foundation during periods of more downside volatility in the equity markets. But to the point on the commodities, they've taken a big hit earlier in the year. So let's talk a little bit more about that growth value discussion that we just had. Because what we're showing here is the second quarter performance, along with the year-to-date performance, by market capitalization, so small cap, mid cap, large cap, and by style, value versus growth. And as you look at these numbers, it's going to be pretty apparent growth is outperforming value. And for the most part, large cap is outperforming small cap, at least on a year-to-date basis. Okay, at least on a year-to-date basis. So this chart here really, Jonathan, is getting to that discussion on growth versus value. And it's doing what? It's showing the individual industry or sectors by the category?
Yeah, absolutely. So if you look at the top half of the slide, we're looking at the value parts of the economy, where we have bigger weights in the value indices. And so you'll see, certainly there were nice bounces in the second quarter with energy, materials, but those are still relatively small components. The bigger components would be financials, real estate, industrials, and they had a nice increase, but are still down on a year-to-date basis. Whereas in the growth, certainly consumer discretionary led the way, then technology. Those are big components on the growth side, and so when you see it on a year-to-date basis, they're all positive. The only sector that is slightly negative on the growth side would be healthcare. And so you can clearly see why growth is having a better year.
Sure. Well, let's talk a little bit here over the next couple of minutes, Jonathan, about the international markets and about the bond market. So here we're showing that the international markets during the second quarter, pretty much across the board, had pretty strong performance, while still year to date, for the most part, negative.
Yeah, absolutely. And I don't know if this is data mining or not, but when you look at the year-to-date numbers internationally, it does appear that those countries and areas that have had kind of more damage from COVID, their markets are down the most. So certainly Latin America, and you think of Brazil, you think of Spain, Italy, and the UK, whereas Germany seemed to have an early handle on it, and with 50% of their economy being industrial, it seems like reopening has been a bit easier for them, and their markets have responded.
Well, and then as we transition into bonds, we're seeing here that credit spreads have narrowed. So returns during the second quarter were pretty good.
Yeah, and again, this was really all due to the Fed stepping in and supporting the credit markets and buying bonds of varying varieties. But when you look to the left side, which would be kind of the more high risk areas of the market, it was the narrowing of the spreads that led to that performance in emerging markets, high yield, and corporate. Whereas when you look to the right side, you're really thinking more about interest rate trends, and interest rates really did not move that much in the quarter, and as a result, those returns in the second quarter were more modest.
Okay. Now we're talking about credit spreads and fixed income returns. I guess the one thing to point out is that, and I apologize, it looks like we're having another issue here with the slide progression. There we go. The default rates. So default rates basically are who are defaulting on their bonds. They're not basically able to pay back or meet their obligations on the credit side. And we're seeing an uptick in these default rates. Is there anything more that we want to touch on? My presumption.
Yeah, I would say, that is something we'll want to continue to watch, because certainly um, we're it's going to be the progression of COVID, and whether there are more lockdowns in our future. But if that doesn't happen, it does seem that the fiscal support and the Fed support is helping, because if you look back to prior recessionary periods, the default rates at this point were much higher than where they are. And then the other side of this slide is showing the recovery rates. And so, it's something to watch, but while it's negative in the short run, it is encouraging that it's not a lot worse.
Well, and I guess as a devil's advocate, to take the other side of that, there are some saying that it is because of the fiscal and monetary policy that we're not seeing the default rate increase as we normally would at this stage, but that the monetary and fiscal policy cannot continue forever, and we may just be delaying the inevitable or pushing off a quarter or two what would otherwise happen anyway. And hence some argue that we're throwing good money at bad companies that in the end will fold anyway.
That's a strong possibility,
Yeah.
definitely. Because later we do show on a slide all of the companies and the bonds that they've issued. So that could make things worse.
All right. Well, with that, let's talk about Silver Oak's outlook, and we're going to go through this section relatively quickly. I think we've, talked a lot about these individual components already as it relates to the U.S. economy. Obviously, we had an exceptionally sharp kind of recovery, and we'll see how brief this recession is. Obviously, we are technically in a recession. We'll see when technically we're called out of the recession. But it was a sharp recovery from a very, very sharp fall off. And hopefully the momentum continues. But as we've said many, many times today, a lot of this is going to be predicated on COVID. And a lot of what we've seen in the recovery is supported by the fiscal and monetary policy that's been in place so far. So that can't continue forever, but hopefully by the time that subsides, the economy will be back maybe on its feet and kind of able to support itself. One point here, I guess I went through it a little quickly, but back to one of the sub-bullet points, will policy response be inflationary? This is something we are going to be watching. Is all of this money that's being pumped into the system, will it cause inflation? It's not something that I think we have to worry about today, next week, or the next couple of quarters, but it is something that everybody should be aware we're following. Then, from an international economic perspective, we've already touched on the fact that there are certain parts of Europe and Asia that seem not to be seeing a significant resurgence in cases of COVID as we are. I know Hong Kong, I think, has most recently had maybe an uptick, but there are other areas in Asia that look to be like China, getting back online a little bit more quickly than the US, which frankly makes sense since they were first to see it as well. As far as our outlook on the equity markets, again, getting back to the fiscal and monetary policy, what Federal Reserve and what the Congress is doing, that's likely to continue to influence asset returns. Valuations are elevated. We've talked about that. I don't have to tell anybody that uncertainty remains. It's all predicated on the health side of this equation. Now, we haven't touched on the election. I briefly mentioned it, and we're going to show some slides with regards to market performance over different parties running the country. Growth valuation is stretched. We have touched on that as well. I think the key here, as we look at the equities, is that there is a wide dispersion of potential outcomes. because of all the factors we've discussed. So diversification continues to be important. Don't believe you can time the market and you know which asset is going to go up more than other assets. Diversification is key in these periods. As far as bonds, the Fed is pumping in trillions of dollars. I mean, we are talking about trillions of dollars. And they're out in the market every day buying bonds, something that they've never done in their history. But they're doing it constantly right now. So we're going to see them continue to manage their balance sheet in hopes of continuing to prop up the markets. I would say focus on credit quality. Don't swing for the fences when it comes to bonds. There may be some select opportunities if credits spreads widen, but really you should only look at those opportunities for the most risk-tolerant investors. If you don't have a stomach for some volatility in your bond portfolios, don't even worry about those credit spreads widening. Stay focused on high quality. So let's talk about what we've been through, Jonathan. And here we're going to see the performance of the markets since really the market low. And what we're seeing is a huge rebound off of what was the fastest market decline on record. And I know some of this is predicated on individual stocks driving a lot of the performance. So is there any one particular or a couple stocks you want to point out that have had a large contribution to these return numbers?
Sure. Many of you may have heard of the concept of FANG stocks, so Facebook, Amazon, Netflix, and Google. When you look at, say, the top 5 stocks in the S&P 500, they make up now 27%. If you look back even to the 2000 bubble, they were less than 20%. But these type of large cap tech companies make up an outsized portion of the S&P, which has been kind of driving returns. And obviously they make up an even bigger component of NASDAQ. And that's why that position is higher. But when we look at from the bottom in March through 722, Apple is up 70%, Facebook is up 60%, Amazon is up 68%, Netflix is up 47%. And again, these are growth companies, and that's why we're seeing that disparity between growth and value.
So a big question that I think a lot of people are asking is, have we gone too far up too fast? Is it really too soon? And I think what this chart here is trying to show is the magnitude of what we have seen. The dark line, the black thick line, is this recovery. And it's showing how we really have almost gotten back to where we were in a very short period of time. So on the x-axis are the days since the peak. Whereas in prior market drawdowns, when the market was really drawn down because of big pullbacks, it's usually taken quite a bit longer, correct?
You know, absolutely. If you really want to look at it, we have essentially gone down and almost fully recovered in the same space of time that in past drawdowns, the drawdown wasn't even over yet. And so this has been much quicker. We've almost had a full market cycle in the matter of months, which in past recessions took 2 years.
And of course, nobody can really answer the question, have we recovered too fast? Is it too soon? But the one thing to know is this recovery comes after an unprecedented market drawdown. I mean, we've never had to literally shut down our economy at our own doing. It's usually, some outside force, and it doesn't impact the entire economy either. So it's a historic recovery from a historic drawdown. So as we look at that kind of impact over history, we're showing here that we think the GDP is going to be at negative 12% in this kind of recession cycle, Jonathan, and therefore
Yes.
worse
Yeah,
than
and
the financial crisis, but less than the Great Depression.
yeah, absolutely. This is JP Morgan's, estimate. And so certainly it is a bigger recession than what we saw in the financial crisis, but nowhere near what we saw in the Great Depression. And in the next few slides, we'll show you, but I think one of the biggest factors this time versus then was just the response by the government with stimulus and by the Federal Reserve by backing the credit markets.
Well, and that leads us to this slide where we're showing that really unprecedented support, fiscal support here on the economy, and this is obviously showing as a percentage of GDP.
Absolutely. And so the projection is we know we've been running budget deficits in prior years, but this is a pretty big jump. And this estimate, though, for the next 2 years assumes an additional trillion for this year, which looks like that will happen, but it also assumes one for next year. So it could be a little less if that doesn't happen.
Well, and here we're seeing really, again, that unprecedented Fed support with, their balance sheet increasing significantly. We saw it during the Great Recession bump up, and now we're seeing another big bump up, which gets back to, hey, are we going to start seeing inflationary pressures at some point? This slide is showing that massive debt issuance in the US. So it's not just the government that's putting money out into the system, but a lot of corporations are taking advantage of the low interest rate environments to finance via some debt issuance. And then, of course, it's not just the US. This has been really a coordinated effort across most of all the major central banks. So again, just talking to the fact that there are trillions and trillions of dollars in the system today that literally were not in the system in January, February. And that really gets back to the valuations of the markets. That money's got to find some place to go, right, Mark? Right, Jonathan?
Yeah, absolutely. And this could be somewhat what has driven the market up is that excess liquidity. One of the statistics we've heard is that 25% of the trading volume right now is through individual investors with small accounts. And that's normally about 10%. And so and there's been a clear consensus that investors in the short run have favored companies where their business models have been intact in COVID, and that's been really the technology side, and that I think has been what's driving up valuations.
Well, and this chart is showing where valuations are relative to history. So right now it looks like we're at about 21 times forward PEs. The average is around 16 times. So it's hard to argue that the markets aren't overvalued. But that doesn't mean that the market valuation has to come down. Again, they may be overvalued based on fundamentals, but that gap between valuations and fundamentals, it can be filled by, well, so far it's been filled by trillions of dollars of stimulus. Or relief, however you want to call it, whatever you want to call it. That money's got to find someplace to go, and it's found right now the equity markets. And as you said earlier, valuations can stay stretched for a long time. They are not good predictors of short-term performance. Maybe longer-term performance, but certainly not short-term performance. And of course, we have shown this before, but I don't think it's probably to anybody's surprise that it could be argued the US markets are the most overvalued relative to the international markets, because what we're seeing here is in gray, the S&P 500, the US markets. In, well, I'm going to take a guess, I'm colorblind. Red, maybe? What color is the ACWI, Jonathan?
Uh, you know, honestly, my screen is having an issue.
Okay, so it
If I
might be red,
remember,
might be purple. Anyway,
I
for the
think it's
color,
purple actually.
okay, maybe it's purple. That's the international markets. That's the ACWI. And you can see that the ACWI really has never recovered to the extent that the S&P 500 has recovered. So a lot of people are leaning a little bit more on the international side just because valuations seem to be less stretched there than they are on the US side. That really gets us to maybe the most important slide of all, and that is my Venn diagram. I love walking through the Venn diagram because it helps segment different concepts like politics, economy, and the markets. And it really highlights, please try not to make investment decisions, which fall in the markets category, based on your political leanings or even based on economic data. Because remember, that economic data is always backward looking, whereas the markets are forward looking. So we really should segment out how we're making our decisions. And as it relates to politics, and I almost cringe thinking that we're going to get into a discussion about politics, Jonathan, but what we've shown here are just the simple numbers that typically in a 4-year presidential cycle, the third of the 4 years is the best for the stock markets, that they go up the most during that third year. And the fourth year tends to be the kind of mediocre along with the first and second. Is that a fair assessment of what this slide is trying to show us?
That's a fair assessment, and what I will note is that is a fairly broad conclusion to, and no matter what endpoint, beginning point, data source that you use.
Okay. So then, since we've navigated our political discussion very well so far, let's go to this slide. And hopefully I can get it on the screen here. Well, it's not going to quite show, I don't think. But what we're showing here, oh, here we go. Each line is a different makeup of, I guess, political parties, whether it's a Republican president, a Republican sweep, looking at all the elections, a Democrat president, a Democratic sweep, etc. And we're seeing that pretty much across the 4-year cycle, performance is very close to each other. There's minor deviations, but not that much. And maybe even the next slide shows it better, where in the dark blue, we have the market performance after 2 years of the presidential election. And in the light blue, the returns after 4 years. And yeah, there may be some deviations, certainly amongst these different categories after 2 years, but really that narrows up pretty tightly after that full 4-year cycle. And frankly, I could probably find data that's going to skew one way or the other, depending on what time frame we're using, depending on certain definitions. So in the end, quite frankly, I really don't think that it matters that much. I know a lot of people like to data mine and get information that supports maybe their political leaning, but in the end, I think it probably pretty much works out to happenstance. Believe it or not, I know it's hard to believe, but that's pretty much what the data shows us. And what the data is showing us here is really specific to what would happen projected or estimated based on if there was a change in an administration. And let's say that that Biden gets elected based on his tax policy. what would we expect to happen to earnings? And I say we, honestly, this is JP Morgan data. So JP Morgan put together an assessment of the Biden's most recent tax policy and its impact or projected impact on S&P earnings. And you're going to certainly see, I think it's undisputable that certain components of that tax policy will draw down earnings. I think it's kind of hard to argue otherwise. But there are other components that would probably add to earnings. And the net effect really isn't all that much. I mean, JP Morgan is indicating a slight decrease in projected earnings from 163 to maybe 159. That is so kind of within the realm, I would say, of kind of the error factor that I don't know that it's really reliable to say that it would be hugely negative or hugely positive on earnings outcome over the next couple of years. With that, let's talk about a couple of updates and reminders. So tax season is over. Yay! It's the longest tax season ever because, of course, 4/15 got pushed back to 7/15. So not only did it feel like a long tax season, it literally was a long tax season. I mentioned we continue to work here at SilverOak under our business continuity plan. Having said that, everything is as it always has been. Hopefully, you as a client have noticed zero impact, and that's really our objective. Our global optimization project has been completed. As a result, we're making a couple of adjustments to our investment quality scoring system list, which we'll be communicating to those impacted clients. We'll have a very interesting behavioral finance white paper coming out very shortly. And just a reminder, now is a great time to review your estate documents. If there's ever a good time, it's now. And to compile mid-year tax projections. We're obviously doing that for our clients, but if we're not working with you on a tax preparation or projection basis, you should do it for yourself. And a reminder that 2020 RMDs are not required, and you have until August 30th if you want to back out that RMD that maybe you already took earlier in the year. August 30th is the last date to reverse those RMDs. Lastly, wear your face mask. Stay safe, stay healthy. With that, if there are any additional questions, I encourage you to reach out to your advisor or call me. I'm at 952-896-5701. And we also encourage you to reach out to your advisor if you have specific topics you want us to discuss in our next webinar. Thank you for your time and have a great day.